Welcome to my channel. I'm going to show you step by step how to value a stock to determine if it's a buy or a sell. At the end of the video, we're going to look at the financial ratios of the company. Leave a comment and I'll be sure to answer. The company we're going to look at is Pasira BioSciences. This company focuses on non-opioid pain management. Let's get started with the model. They have a market cap of $2.7 billion, so that's the value of the company according to the stock market. Let's see what they're trading at. $62.51, so that's one share of stock. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. Now I'm going to pull their actual free cash flows. That's cash flow from operations minus capital expenditures. Capital expenditures are investments in property, plant, and equipment, like real estate or machinery. Let's pull the net income. That's a profit and loss on the income statement. So they have negative net income every year. Let's get the revenue, which are the sales on the income statement. The sales have been increasing every year. Their free cash flow is positive except for a small negative one year. So that looks pretty good. Even though they have negative net income, the free cash flow is what you need to look at. Let's look at a capital structure of the company. The interest they pay in their debt is $22 million. Let's go to the balance sheet to see how much debt they have. $306 million of long-term debt. That's debt due after 12 months. They pay 7% interest on their debt. Let's get the beta so we can figure out the cost of equity. The beta is how volatile the stock is relative to the market. Beta of 1.28, so the stock is a little more volatile than the market, but not too much. Let's go back to the balance sheet, get their current assets. We need to calculate the current ratio later, and current assets is the numerator of that equation, and that's $409 million. And that's made up of $292 million cash, $47 million net receivables, and $58 million of inventory. We also need the current liabilities. That's $108 million. Let's see what that is. That's $12.8 million of accounts payable. That's what this company owes other companies. $1.3 million of taxes payable. That's what they owe the government over the next 12 months in taxes. $48 million of accrued liabilities. These are expenses that the company has accrued but it has not yet paid, and $18 million of other. Let's look at their equity. That's $354 million. That's the value of the company according to the balance sheet. $42,000 of common stock, negative $400 million of retained earnings, so they're operating at a loss historically. $322,000 of accumulated other comprehensive income. Let's go back to the income statement, get their operating income, $35 million. We need this to calculate the interest coverage ratio later. Let's look at a capital structure. 46% debt, 7.2% cost of debt, 54% equity, 12.2% cost of equity, 9.8% WACC, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using a weighted average cost of capital, and we get a value of the company of $3.6 billion. We divide that by 43 million shares, and we get a calculated stock price of $84. They're trading at 63, so they're trading at a 26% discount. So it's a buy according to the model. Simply Wall Street's even higher at 111, so they're also saying the stock's a buy. Let's see where the stock has been trading at. And it looks like it peaked at around $85 a few years back, but it's come down quite a bit. But it's come up during coronavirus, so it seems like it's doing better during this difficult time. Let's look at the financial ratios. Negative PE, a bad price to sales, and a bad price to book. So PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 6.4, so investors are paying $6.40 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 7.6. So investors are paying $7.60 for $1 book value. Good current ratio, good interest coverage ratio, and bad ROE. Current ratio is current assets over current liabilities, so they can easily cover their current liabilities. ROE is net income over equity. They have negative net income, so they have negative ROE. Interest coverage ratio is EBIT over interest expense, so they can cover their interest expense 1.6 times. And they're in the industry, drug manufacturers, specialty, and generic. And I haven't done a video with a company in this same industry, so I can't compare them to anyone. So let me know what you think of the video. Leave a comment. I'll be sure to answer. Thanks for watching.